This roadshow is brought to you by ResearchBytes.com.
Gentlemen, very good morning. I'm Arun Kumar, CFO Vedanta. Thank you for joining us today for our FY 2018 results. Let me introduce our speakers and go over the agenda for the day. Our chairman, Mr. Anil Agarwal, will give an overview, followed by a review of FY 2018 by our CEO, Mr. Kuldeep Kaura. This will be followed by my update on the financials. Mr. Kaura will then cover some details on our growth projects. This will be followed by a question and answer session. We also have several of our business leaders on the phone with us today. We have Sunil Dugal from India, Zinc India, Samir Khere and Abhijit Pati from the Aluminium Division, Sudhir Mathur from Oil and Gas, Dashni Naidu from Zinc International, Naveen Singhal from Iron Ore, and Stephen Din from KCM. So with that, I'd like to hand over to our chairman.
Good morning, ladies and gentlemen. I welcome you all to the annual result presentation of Vedanta Resources. We had an excellent year, and our strong and financial result for 2018 demonstrate our world-class, diversified, low-cost, scalable assets, robust balance sheet, disciplined capital allocation, and experienced team. Let me start by talking about a topic that is close to my heart: the positive contribution that Vedanta continue to make in supporting local communities, creating job and operation as a responsible corporate citizen. Vedanta has always maintained that financial return alone are not the mark of good business. Over the course of last year, we have contributed $5.4 billion to the exchequer. We have invested about $39 million in the various social programs that have touched the life of over 3.3 million people across India and Africa. As we go forward, I'm confident in the company's ability to deliver superior shareholder return by building upon growth opportunities. I'm particularly pleased that with our strong focus on productivity, we have created a resilient portfolio of businesses. The team remain committed to all-round operational excellence to attain the true potential of our assets. We are also capitalizing on Vedanta's unique position to meet India's growing demand for resources. Vedanta provides an attractive opportunity to invest and participate in India's growth story. I am pleased that the Indian government has introduced a number of pro-business reform in the past year. Key reform around opening commercial coal mining to the private sector and the launch of open acreage licensing policy in the oil and gas to improve exploration are just some of the steps taken towards creating a more favorable business environment. The new bankruptcy code provides an opportunity for both lenders and corporates to come to a win-win solution. As we complete the due processes, we look forward to the integration of electro-steel with our iron ore businesses. At KCM, we have invested significantly in the businesses that have seen early operational improvement. Dashni Naidu, appointed as the CEO of Africa Base Metal, gives further imputes for commitment to the region. I'm also pleased that many brownfield opportunities that the team are developing, particularly in the oil and gas zinc businesses. With various growth opportunities in the pipeline, our performance in FY 2019 will be the ever strong. At the same time, we will take a disciplined approach to capital allocation for the growth opportunities and increase shareholder value. As you know, S. Venkat has recently been appointed as our new CEO. He brings an impressive track record, the right leadership, skill, and experience in the key market of our operations. I'm confident that he is well placed to continue to drive the group's strategy when he takes up his role in August. With this, let me hand over to Mr. Kuldeep Kaura. Thank you. Thank you very much.
Thank you, Chairman. Good morning, ladies and gentlemen. When I took over as CEO in September 2017, most of our businesses were in the middle of their planned ramp-ups. Today, as I share with you full year results, I am pleased to report that the businesses delivered on the ramp-ups as per plan, and we achieved record production across our businesses. The commodity prices saw appreciation over the year, fueled by supply-related disruptions, stable to growing demand, a weakening dollar, and a bullish global growth indicators. We benefited from this, and coupled with the robust operational performance for the year, coupled with the robust performance, delivered a strong set of numbers. Let me spend the next few minutes on our performance for the year. I start with safety and sustainability. Vedanta remains focused on zero harm, zero waste, and zero discharge. It is therefore with great sadness we report 9 fatalities during the year. We remain committed to bring Vedanta to the best HSE performance in the sector. These fatalities have resulted in increased focus from the Group Executive Committee. Some of the areas we are focusing on are rigorous implementation of safety standards and management of high-risk areas. We have augmented our HSE organization and inducted 10 HSE experts with global experience. Our employees and contractors spent about 1 million hours in safety training last year. On the positive side, our oil and gas business has been awarded British Safety Council's 5-star rating for all of its Rajasthan and midstream assets. Hindustan Zinc is now ranked 11th on the Dow Jones Sustainability Index for the metal and mining sector and was inducted into prestigious Dow Jones Yearbook. In the area of environment, we were able to exceed our water savings and energy savings targets and also reduce the greenhouse gas intensity materially. Improvement opportunities through third-party audits of our tailing and ash management practices have been identified and corrective actions are being implemented by businesses. Finally, work on our flagship CSR program, Nandgarh, continues. We are perfecting the pilot and remain committed to building 4,000 Nandghars. Now, moving to our FY18 highlights. Our operational performance was strong this year on various fronts. Record production at Zinc India and successfully completing the full transition to underground operations with no significant increase in costs. At Oil and Gas, achieved a production run rate of 200,000 barrels per day towards March end. Record production at Aluminium and exit production run rate of 2 million tons per annum. Increase in volumes across businesses helped us deliver strong financial results. Full year EBITDA was $4.1 billion, 27% higher year on year. Robust EBITDA margins at 35%, supplemented by favorable markets despite inflationary cost headwinds. Free cash flows of $925 million and reduced debt by $3 billion. We made good progress on our growth projects in 2019. As Zinc India, we will hit a run rate of 1.2 million ton in FY19 and are on track to achieve 1.2 million production in financial year 20. The Hemsberg project is on track to commence production in mid of this calendar year. In the oil and gas segment, contracts of $1.3 billion have been awarded on the new projects and execution has commenced. First oil from these projects will flow in this quarter. On electro-steel, the closure of the acquisition is subject to completion of due processes and is a step towards value addition for our iron ore business. During the year, we also focused on all-around operational excellence. This was through debottlenecking of our assets, adopting technology and digitalization, strengthening people practices, vendor and customer base enhancement, and spend-based optimization. For example, at the Sindesar Khurd zinc mine, we have piloted digital technology for transformation to an automated mine. At Hemsberg, the ongoing digital project will have leading-edge systems to report on a real-time basis and enable online optimization. Moving towards our business highlights, at Zinc India, we achieved record annual refined metal production of 960,000 tons, along with silver production of about 18 million ounces. Our cost of production ex-royalty at $976 per ton was 18% higher year on year in dollar terms due to increase in input material prices and lower grades. Our production was stable as Zinc International. We had some cost headwinds this year due to higher stripping cost of pit 112 at Scorpion and unfavorable local currency appreciation. At oil and gas, our debottlenecking efforts paid dividends as we exited this year at a production rate of $200,000 barrels per day. Our aluminium business delivered record volumes and exited the year at a run rate of 2 million tons per year. However, inflationary cost pressures impacted the cost of production. We have taken measures to address these costs, which we'll cover later. Moving to power, TSPL delivered record 90% plus availability in the second half of the year and delivered strong growth year on year. At Iron Ore Goa, we produced 4.9 million tons this year. As you may be aware, the Supreme Court in February stopped all mining in Goa with effect from mid-March, as a result of which our operations are also shut currently. Excuse me, there's some disturbance. Veena, can you come? I think in my bag there's a phone with the alarm. Take it out. No. Sorry. At Copper India, we had a record production of 403,000 tons this year. Average TCRCs were lower 5% year on year at the back of strong copper demand and prices. Our operations at Tuticorin are currently shut as our application for renewal of consent to operate has not been approved by the Tamil Nadu Pollution Control Board. We are engaging with the regulatory body for a resolution. However, you will have seen the tragic news yesterday about the protest in Tuticorin. We were shocked and saddened to hear about the incident and are working with the relevant authorities to ensure the safety of our employees, facilities, and the surrounding community. At Copper Zambia, we delivered total integrated and custom volumes of 195,000 tonnes. We now have a long-term contractor partnering model in place to help deliver improved fleet availability and TLP reliability and therefore drive higher productivity. We have put in place the key building blocks and now look towards an improved performance in FY 2019. Moving to our strategic priorities for the year, operational excellence is a priority I have spoken about earlier. We continuously strive to improve our operation, sweat our assets, optimize costs, and improve realization to benchmark levels. Preserving our license to operate is a key priority. Our commitment to zero harm, minimizing environment impact, and creating sustainable value for all our stakeholders remains important to us. On the financial side, our focus is on generating strong cash flows and maintaining a robust balance sheet through prudent capital allocation. I am excited about the growth opportunities in our portfolio. The many brownfield opportunities, and in addition, some exciting inorganic opportunities in the resource segment align well with the demands of fast-growing Indian market. Exploration and addition to reserves and resources underpin our growth strategy. For instance, at Zinc India, our continuous focus on exploration has resulted in gross addition of over 19 million tons, enabling us to end the year with estimated R&R of about 411 million tons. I'll now hand over to Arun, who will take you through the financials.
Thank you, Mr. Kora. I'm happy to report another strong quarter of numbers, largely led by operations. Before I dive deeper into the numbers, a few highlights. We reported the highest yearly EBITDA in 4 years at $4.1 billion, a 27% growth, with H2 at $2.4 billion, which is 39% higher than H1. Margin continues to be robust at around 35%, excluding custom smelting. ROC measured conservatively on a post-tax basis has touched approximately 15%, an improvement of 210 basis points. Annualized Q4 number, of course, will be much higher. Net debt to EBITDA improves to 2.4 times. And for those of you following our principal subsidiary, Vedanta Limited at India, it recorded a net debt to EBITDA at about 0.9 times. Gross debt is down by $3 billion, while net debt increased. We believe these are important milestones led by strong operational performance with volume growth across every business segment, of course, aided by a good price environment. The volumes and costs were largely in line with the guidance. The board approved a final dividend of 41 cents, thus taking the total for the year to 65 cents. While we have the detailed income statement in the appendix, I just thought I'll cover a few highlights of that. As you're already aware, given announcement in March, we took an impairment charge in our iron ore of $534 million net of tax, consequent to the Supreme Court order to cancel all mining leases in Goa effective 16 March 2018. As indicated a few weeks ago, we took an approximately $900 million net of tax impairment reversal in the oil and gas business. We've been talking about this over the last 18 months, more specifically in the interims, that 7 or 8 growth projects, what we call key growth projects, which Mr. Kora also alluded to, in the next few years will be executed. And we made all of this work at IRRs exceeding 20% at a conservative 40 Brent. This has led to re-rating of the reserves and resources, and hence overall valuation of the business, with the accounting impact manifesting as an impairment write-back. On finance costs, The blended cost of borrowing for FY18 was 7.15%, significantly lower to 7.5% in FY17. With the yield curve hardening, we expect the cost to move up by anywhere from 25 to 50 basis points in FY19. On the investment income line, we earned approximately 7.4% pre-tax, given a lot of cash in India, and continue to invest it safely in high-quality instruments. Reported numbers, of course, impacted a bit by the mark-to-market adjustments, accounting adjustments, given the yield curve movements. For FY19, one should expect around 7% plus underlying pre-tax return on our investment portfolio, of course, subject to mark-to-market accounting. Depreciation for FY19 should be significantly higher, given all the growth that we are likely to experience in the mining and the oil and gas businesses in the full year, as well as the impact of ramped up assets in aluminum during the year. Additionally, Amsberg coming online, and of course the higher asset base given the impairment reversals. So one should expect a higher depreciation in FY19. For FY18, the final tax rate was 32%, excluding dividend distribution tax and special items, which is more or less in line with our guidance of around 30%, which we had given during the year. For FY19, the overall effective tax rate is likely to be around the similar range. With that, let me move on to the next page on the EBITDA bridge. As you can see on this page, 300 million of incremental EBITDA was driven by strong operational volume growth across the businesses. We had recorded annual production in Zinc India with an 18% increase in integrated metal, 23% up on silver, and a record aluminum production with a run rate exit of 2 million tons per annum. This lays the foundation for a further increase in volumes for FY19. If we look at the guidance given in the annexures, especially in the oil and gas business, Zinc India, Amsberg and Zinc International, and the full year impact of the stabilized volume in the aluminum sector. On the external side, while prices held, significant input inflation and currency appreciation offset half the price gain. Moving on to the next page on net debt. During the year, we remained focused on generating cash. We generated strong cash flow from operations of nearly $2.6 billion, of which it helped reduce the net debt. However, due to record dividends by subsidiaries, the glass acquisition earlier in the year, and some proactive adjustment to replace some of our working capital funding with a permanent debt funding, we defrayed the earned cash, thus taking the net debt higher. Again, on the next page on refinancing and improving maturity profile, the company continued to manage its debt book with the objectives of delevering, reducing the cost of the borrowing, and extending maturity. During the year, we completed successfully a proactive refinancing of nearly $2.4 billion through bond issuance and bank loans, and improved the average maturity at Resources PLC to above 4 years from around 2.5 years a year ago. Continuing with our focus on debt reduction, the gross debt came down to about $15 billion. It's lower by about $3 billion compared to the beginning of the year. On the back of strong operational and financial performance, Moody's upgraded the corporate family rating by 1 notch to Ba3 stable. We will continue to generate strong cash flows on the strength of higher volumes and operations in FY19, and will continue to allocate wisely to growth projects with high returns, delever further, and yet provide adequate return and appreciation to the shareholders. On that note, let me move to the next page on CapEx guidance. The CapEx guidance for FY19 comes in at around $1.5 billion against the 18 actuals at $0.8 billion, which was marginally below our guidance at mid-year. The increased level of CapEx is largely driven by the oil and gas business, given all the growth project announcements, which we believe will lead to much higher production levels, with the immediate FY19 guidance at 220 to 250 kBOPD, which will be an increase of 20 to 35% whichever range you take at the bottom or the top end of the range. And Sudhir will talk a lot more about this when he talks about oil and gas. Zinc India management team covered their guidance in the zinc results day before, with plans announced to take the production to from 1.2 million tons to 1.35 million tons in the near future. Zinc also includes the spends in Amsberg as it achieves commercial production mid-calendar 2018. The entire capex on this page will be self-funded from the EBITDA and cash flow earnings of the year. And all of them, every single project out here will return an IRR of about 20% or more at conservative price assumptions, which is well above our WACC. In summary, focus on fundamentals of operational excellence, generating free cash flows to fund our capex, delevering, and adequate shareholder returns will be our endeavor. Priorities around keeping the balance sheet strong and staying proactive on refinancing, credit improvements, and keep improving the ROCE will continue. With that, thank you all, and back to Mr. Kora for his brief on the growth projects.
Yeah. So before we talk on growth projects, let's look at a few points on what's happening in India. India is our key market and production base. Indian economy is one of the fastest growing G20 economies and is projected to grow at around 7 to 8% per annum over the next few years. Currently, per capita consumption of metals in India is 70 to 80% below global averages. As the economy grows and the intensity of consumption increases, the demand for key commodities will increase multifold. Vedanta, as the only diversified natural resources company in India, is uniquely positioned to cater to that demand. Vedanta stands out from its peer as it has many brownfield opportunities for growth. This slide is a snapshot of projects across various businesses, detailing both the near-term growth under execution and our medium-term growth options. As an organization, we are well equipped to deliver on these growth projects with our world-class resources, requisite management bandwidth, and strong cash flow generation from our operations. Moving to oil and gas. In the oil and gas business, we are moving towards our vision of contributing 50% share in India's total crude oil production. The key to realizing this vision is augmenting our reserves, and as you can see from the slide, that since 2009 to date, we have added 1.3 billion barrels of oil equivalent in production and reserves through use of leading-edge technologies. Our growth projects include a rich mix of enhanced oil recovery, tight oil and tight gas projects involving gross capex of $2.3 billion over the next 2 to 3 years, and at IRRs in excess of 20% at oil prices of $40 per barrel. These projects will result in doubling of our production progressively over the next 2 to 3 years. Contracts of about $1.3 billion for these projects are already in place. Project execution is underway with 4 rigs currently at site in Rajasthan, which will be scaled up to 9 rigs by August 2018. The polymer enhanced oil recovery at Mangla, which is now a global benchmark, is being replicated in the Bhagyam and Aishwarya fields with a target to deliver an incremental 5% recovery. The first well has spud both at Bhagyam and Aishwarya in April 2018. We are going for alkaline surfactant polymer, or ASP in short, to further boost recovery by about 10% from our MBA fields, taking overall field recovery to around 45% level from the base level of about 30%. The success of the ASP pilot in Mangla has paved way for us a phased manner implementation of ASP in the MBA fields. Moving on to tight gas, the first well has spud in April 2018. We're also looking at early production through a rental arrangement of surface facilities as soon as the GIGL pipeline is ready towards the end of first half 19. We are on track to monetize Aishwarya Barmer Hill, our first tight oil project. The two-rig drilling program comprising 39 wells is on track to spud in May 2018. In addition, we are upgrading liquid handling capacity at the Mangla processing terminal to accommodate post-expansion volumes. In aggregate, we are seeking to add around 375 million barrels of gross reserves on account of our growth projects. We'll also continue to invest further in exploration in this business. We have identified a number of new and high-impact undrilled leads and prospects in Rajasthan and will start drilling 17 to 18 wells in August. Beyond Rajasthan, we have 100% participating interest in KG offshore block. The first well of the two-well exploration campaign at KG has spud in April 2018. We're also actively looking to add to our current acreage across key basins in India under the government's open acreage licensing policy. We have bid for all the 55 blocks on offer and expect to increase our exploration portfolio significantly to continue building the reserve and resources base aggressively. Moving to aluminium, we are pleased with the strong ramp-ups of this year in our aluminium business, exiting the year at approximately 2 million ton production rate. We'll continue the full ramp-up of third line of 1.25 million ton Jharsuguda smelter within the first half of the year. This year was, however, not without its challenges. Inflationary cost pressures across alumina, coal, and carbon accelerated the costs in the business. Amongst input commodities, alumina continues to trade at elevated levels, driven by the supply tightening from Alunorte's partial refinery shutdown and uncertainties due to US sanctions on Rusal. While our medium-term target is to achieve cost of production of about $1,500 per ton, in the immediate future, we are focusing on improving costs within our control and also improving realizations. Some of the key actions to reduce costs are: on alumina, we are targeting production of about 1.6 million ton of captive alumina in FY19, with the potential to move up to 2 million ton, thereby reducing imports of high-cost alumina substantially from current levels. Increasing the share of Odisha bauxite significantly will add high-quality, low-cost bauxite to our refinery feed mix. Together, these factors will lead to appreciable reduction in alumina costs. On power, we are working towards achieving benchmark level of plant operating parameters, which will reduce non-coal costs. We're also working towards increasing our linkage coal mix from 45% currently to a target of 70%, thus reducing the share of high-cost imported and auction coal. We're optimizing controllable costs, and through elimination of one-offs, we expect COP reduction in the range of $120 to $170 per ton in the year 19. Since the supply dynamics for global alumina and prices for other input commodities remain uncertain, it's difficult to provide an exact guidance for financial year 19 cost of production. Assuming costs of imported alumina, coal e-auction, and carbon stay at average of current year, this would imply a COP of about $1,725 to $1,775 per ton range in FY19. On the product and marketing side, while our vision is 100% value-added production, we are targeting a 35% increase in financial year 19 to a milestone level of about 1 million ton. These and other efforts, along with improved headline premium, is expected to contribute about $50 per ton to the EBITDA margin in financial year 19. While in the near term we are focusing on improving costs and realization, we are also evaluating an expansion of up to 3 million ton in aluminium, possibly through an additional pot line at Balco, which has surplus captive power in place. This will be in tandem with alumina ramp up at Lanjigarh to 6 million ton. Moving on to copper Zambia. Financial year 18 was an important year for us as we transitioned into a new operating philosophy through the business partnering model. Konkola achieved its highest production of the year in March 2018. Encouraged by these operational improvements, we continue to focus on a sustained development and dewatering strategy at Konkola Underground, augmentation and improved fleet availability at Konkola Underground and Nchanga Open Pit under OEM supervision across businesses, strengthening the operating organization and rationalization of cost base. In summary, we have in place a renewed operating model to have substantial improvement in output in financial year 19. KCM has the required infrastructure and coupled with the necessary mine development, this asset has the potential to produce 300,000 ton copper in the medium term. As Zinc India, our strategic vision is to grow our zinc-led output to 1.5 million tons per annum and our silver portfolio to 48 million ounces. I am pleased to announce that Board of Hindustan Zinc earlier this month approved phase 1 of this expansion, which will increase the mine metal and smelting capacity from 1.2 million ton to 1.3 million ton per annum over a period of 3 years. Phase 1 will be implemented concurrently with the ongoing mining expansion of 1.2 million ton, which is now in its final stages. A salient feature of this next phase of expansion will be the use of technology to increase productivity, efficiency, and safety. We plan to deploy autonomous machines enabling 24/7 mining to increase production hours and fleet availability. These measures, along with initiatives like predictive maintenance, will create capabilities for cost optimization and improve safety. In short, our mines will be smart, connected, intelligent mines which will be safer and more productive. We'll be expanding our smelting capacity also simultaneously via debottlenecking of our existing smelters and addition of a new smelter. A new silver refinery of 200 tons per annum will be set up to process higher silver feed. Talking about Zinc International, as you are aware, Hamsburg is the anchor project for our growth plans at Zinc International. It has a huge potential with its large reserves and resources base of 215 million tons with 16 million tons of contained zinc. Phase 1 of the project, which will produce 250,000 tons, is currently under execution and on track for commissioning in middle of this year. Hamsburg Phase 2 can start immediately after completion of Phase 1. In terms of output, we can expect to add another 200 to 250,000 tons metal in concentrate in 2 to 3 years. It is our vision to sell finished zinc metal from Hamsburg, and towards this, we are evaluating various possibilities for converting concentrate to metal. Let me also cover our integration strategy for iron ore and expansions. As I mentioned earlier, at Goa, our iron ore operations are currently shut. Given our commitment to the region and the considerable impact on the local economy, we continue to engage with the government to provide clarity around restarting of mining operations at Goa. On electro-steel, the IBC process gave us an attractive entry opportunity into steel. We see steel as a natural value add for Vedanta's iron ore business. In early April, we received a favorable order from NCLT for our bid to acquire Electrosteel. We are working towards completing this acquisition. Electrosteel runs a blast furnace and produces long steel in the state of Jharkhand. We see a number of opportunities to turn around this asset, including the immediate ramp up to 1.5 million tons and subsequently to 2.5 million tons, and synergies with the to-be-developed Jharkhand iron ore project. Let me wrap up by summarizing our key investment highlights. Firstly, Vedanta's diversified and low-cost production portfolio positions us well to deliver strong margins and cash flow through the commodity cycle. Secondly, we are strongly and uniquely positioned to benefit from India's growth potential. Thirdly, progressively over the next 2 years, we will have significant growth across a number of our businesses. Production at oil and gas will almost double from current levels of 180,000 barrels to about 320,000 barrels per day. Our zinc portfolio will grow from current level of 1.1 million ton to 1.6 million ton across Zinc India and Zinc International. Aluminium production will increase from 1.7 to 2.3 million tons. Copper Zambia will double its integrated production from around 100,000 to 200,000 tons. As a part of our operational excellence program, our main thrust is to adopt digital technology across our operations. We have already implemented this at 2 of our mines and are looking to replicate across our various assets. We at Vedanta remain committed to our philosophy of zero harm, zero waste, and zero discharge. As a growing organization, management remains centered around strengthening our leadership pipeline and building capabilities. All these factors will enable us to deliver superior long-term returns to our shareholders and broader stakeholder base. With that, we can now take questions from the audience. Thank you.
Thank you, Mr. Kora. We'll take questions from the audience here, followed by the operator who will facilitate questions online. And since it's being webcast, our team will hand over questions, if any, on the webcast as well. Thank you.
Yeah, go ahead.
Good morning, Jatinder Goel from Citigroup. Two slightly higher level questions. Firstly, on leverage, you mentioned 0.9 times at subsidiary level and 2.4 times at PLC. Do you think there is a need for convergence, and is there a timeline over which you would want this to be converged, and is there a roadmap that you could lay out to get to those levels where those two entities look reasonably similar? Second one, just on further diversification into steel, you're still probably actively bidding into other entities as well. Do you think Electrosteel is not sufficient, or do you have the capability or need to go beyond Electrosteel as well? Thank you.
Yeah, let him answer this leverage issue, and then
After you.
Yeah. No, very interesting. We fundamentally wanted to be only on the iron ore production. But certain countries and certain continent, the government insists of value addition. Like if you look at Central America, Mexico, they insist, and same in India, they don't encourage only to remain as an iron ore producer. And we are producing already in Goa about 1 million ton pig iron. So we find this, we have a phenomenal mining site, but everybody insists that value addition. So we got this opportunity to bid for the Electrosteel. So we integrate. Then once we are in steel, we have to be player. And we find that the SR is also bidding, and we have put in very reasonable bid. And I'm not sure where it will go. There are other bidder. And if it come through, we can integrate and see how the steel can, one vertical can develop as a major steel player. SR steel and the electro. But at this point of time, we are very comfortable with the iron ore we are producing and electro steel what we got. So we can created a comfort in the government mind that we will be doing the value addition of our iron ore, at least some of the iron ore. So this is for steel.
Yeah, thank you, Chairman. And very important as a follow-up to what the Chairman mentioned, to underline the strength of the operating subsidiary at Vedanta Limited. I think the statistic I shared with you is probably best-in-class balance sheet amongst any corporate group in the country. And all that has been achieved thanks to the volume ramp-up that we've gone through as a journey in the last 18 months. Every single one of our assets is producing good EBITDA at this point of time. If you take our Q4 run rate, the ROC is crossed 20%. So that gives us the confidence to put a step forward on all brownfield growth opportunities and as well as the bolt-on steel acquisition that the Chairman very eloquently explained. So at the PLC level, of course, our journey is getting towards investment grade rating, as I have shared in the past. And if you look at the last 24 months of journey, we're almost back to where we were at the commodity price down cycle. So the key point is the handsome cash flow generation potential in FY19 and beyond at the operating subsidiary. Absolutely exciting growth opportunities in front of us in oil and gas, zinc international, and aluminum realizing its full potential this year. And with that, smartly allocating our cash between shareholder returns and further delevering. Thank you.
Hi, Saurabh Agrawal from Barclays. So a very quick clarification on this aluminium division. You mentioned the medium-term plan of increasing the alumina production to 1.4 to 1.6 million tons. They were, I think, the capacity can go up to somewhere in the range of 5 to 6 million tons. And then the associated bauxite, the local procurement either from the state of Orissa or otherwise. So just if there is any update on that. And the second question related to that was this increase in the value add that is being targeted for aluminium. Will there be an associated capex for that?
Yeah, on this, we have set up this alumina plant, and at the moment we have very small mine in Chhattisgarh, and we are feeding with that. Last few months we are getting from Orissa bauxite, which is helping well. And our cost is coming very well, and we are targeting from 1.5 million to 2 million ton this year. I'm very confident that the 100% bauxite will be available within a year's time. So that we will ramp up to 3 million ton, and then we'll go next phase for 6 million ton. We have allocated not much capital required, but we allocated some capital because the infrastructure has been developed, and very excited about the alumina. We want to first cut on the value addition, and I'm very pleased that our team is working with our existing rod mill, existing billet, and some of the alloy. They are looking forward at least 90% value addition of product what they will make, and they will look like there will be about 70, 80 or $100 million investment. Not much investment will be required.
Just to supplement, I mean, last year we produced about 1.2 million tons alumina. This plant is 2 million ton capacity. It can, with the mix of the bauxite which we are feeding, it will immediately go to 1.7, and then we'll also debottleneck further to 2. And then, as Chairman was saying, our first next milestone will be debottleneck this 2 to 3. And the feeding of bauxite from Orissa has already started. And this is, the merchant mine basis OMC is supplying us this bauxite. And this mine will continue to ramp up to a potential of about 6 million ton, which will supply then quite a large proportion of the bauxite which we require. And on the value addition, I mean, this is really a lot of work is, I mean, no serious investment, as Chairman said, it's less than $100 million. Plus, we also have, about 100,000 ton capacity in Balco, which actually is being, now put into operational and debottlenecked to deliver its full potential. Yeah.
You take on the call.
Yes.
Sure. If there are no other questions in the room here, can I ask the operator to kindly link in the question queue?
Sure. Thank you very much. Ladies and gentlemen, if you wish to ask a question, please press star and 1 on your touchtone telephone. We would request participants to use handset mode while asking your question. Anyone who wishes to ask a question, you may press star and 1. The first question is from the line of Varun Ahuja from JP Morgan. Please go ahead.
Morning, gentlemen, and thanks so much for the opportunity. 2 or 3 questions. Firstly, you mentioned deleveraging and strong balance sheet being a priority. I see that the attributable net debt, something that rating agencies also follow, has been around 8 billion. Although there has been some debt reduction, but if I look at it, how much percentage you hold in each of the asset versus where the debt is, it's still hovering around 8 billion. So there are some new growth projects that you mentioned, and I believe they are in commodities where you expect prices to hold up pretty well. But just trying to understand your thinking, are you comfortable with the current debt numbers, what you have on the balance sheet right now, or would this number further decline from from operating cash flows as well as one-off dividends that you've recently given? Secondly, on debt at KCM, that has been reducing. So just curious how that's being done and what's the total outstanding from Vedanta PLC to KCM. A couple of questions here.
Yeah, thanks for the question, Varun. I think, as we mentioned earlier, the relative net debt to EBITDA has been improving for us over the last 2 years. If I wind the clock back to FY16, I think we were at about 3.36, and it's almost 100 basis points down. Very reflective of the operational strength that we keep underlying. And the fact that we've reached a certain EBITDA level with more significant potential unlocked, given all the growth projects, would definitely take those earnings and the cash flow to the next level. As we also mentioned on the capital guidance page, all the capex will be completely self-funded. So the 3 objectives of capital allocation, which is smart growth projects with high returns, continue to delever. As you saw in the PLC, the debt is below $6 billion at this point of time. It was above the same time last year. And third is ensuring the appropriate shareholder returns at the subsidiaries which are earning, which also means a good cash flow into PLC. These 3 objectives then get balanced out very neatly at any price level, given the fact that our operating philosophy is to be at the first quartile cost curve for every business that we operate in. That gives a position of strength to go through the cycles. Needless to say, the diversified asset portfolio has been a source of strength to the group, as we have repeatedly outlined in the last couple of years, and you see that play out in all the commodity cycles. As regards KCM, Stephen is on the line, Mr. Kora is here. There are excellent improvements in the second half of the year, and some new strategy, contractor strategy has been put in place. I'll request them to sort of outline the same and share the potential of KCM in FY19.
Stephen, you would like to come in?
Yes, thank you very much, Arun, Mr. Kora. So first of all, if I can give you as you mentioned, the debt levels at KCM are reducing. So at the end of Q1, we had an external debt level of 509 million, which at the end of Q4 has reduced down to 376. And then if we look at the balance that we have with Group, at the end of Q1, it was 612. And it has moved up slightly to 622. But overall, the debt level at KCM has reduced. And, this is quite simply as a result of the improvements which are coming through through essentially a change in the operating philosophy where we found that there were certain parts of the business which were mainly legacy assets, and in some cases they were suffering from low equipment availabilities or not having the right level of fleet. So we've looked at certain parts of those legacy assets, and where there is a short life, we have basically contracted those sections out to essentially business partners, and the transitioning is now almost complete, and we're starting to see the productivities, particularly, for example, from the open pits, coming through. But at the same time, we also have the asset at the Konkola underground mine, which, if I can just remind everybody, has just under 300 million tons of resource at 3.5% copper. This has also been looked at in relation to our contracting out philosophy with the business partners. And once again, we have looked at probably the two shafts that we have at Konkola in a different way, but we are once again starting to see the productivities come through. And as you've seen in the outlook for FY19, we're hoping that what the numbers that we achieved towards the end of March and that we're achieving right now in May will continue and grow into the end of the year, and then hopefully these debt levels will reduce even further.
Thank you. If I may just ask one follow-up, after the couple of acquisitions you've done in FY18, including the foray into steel sector, I guess for the near to medium term, and I'm not looking for specifics, but for the near to medium term, are there any potential acquisitions or interesting opportunities that you still see that you would be actively tracking, or is organic growth going to be the focus going forward?
Yeah, whatever we have said, organic growth, which is there. Apart from that, there is nothing for acquiring any new asset.
I think the focus is mainly on the brownfield growth, and which you saw we outlined across all our assets in oil and gas, in zinc.
Yeah.
Thank you. All the best.
Thank you. The next question is from the line of Bharat Shettigar from Standard Chartered Bank. Please go ahead.
Yeah, thanks a lot, everyone, for the call. First couple of questions on the entity-wise cash and debt levels, which is on slide 39 of the presentation. Firstly, I want to understand the $606 million dividend inflow that you got. Is that reflected in the March end numbers?
That's right.
Okay. The other... Hello?
Go ahead. Yes, please.
Yeah, the other question is, if I look at Gain India Holdings, that has about $791 million of cash as of March. Just trying to understand what's the strategy behind keeping such a high cash number at that entity?
If you see the cane business, the production sharing contract is split between two legal entities. So this is actually the handsome cash generation, which is half the asset is sitting in that legal entity. And this cash is available for us for any of the corporate users. And it's earning a very good interest income, as I outlined earlier in my presentation, that we earned about 7.4% on a pre-tax basis on the investment income, while our cost was about 7.15%. So I hope that answers your question.
Sure. The other question is, if I look at the September results, the Holdco had about $900 million of debt repayments due in FY19. That number has come down to $400 million now. So clearly you have refinanced some of that debt due in FY19. Can you talk a bit about what kind of tenor and what kind of interest rates at which the debt was refinanced?
I think the broad picture on PLC is that we've been very proactive on refinancing, And if you really see that the average tenor has gone up from nearly 2.5 years 12 months ago to approximately 4.2 years at the end of March 18. We've been sort of well appreciated by the debt markets, and credit rating has also improved on the back of this proactive refinancing. The costs on an overall basket of borrowings has come down during the year by nearly about 25 to 30 basis points as a result of this kind of smart refinancing that we have done. On the specifics of any of the borrowings in our balance sheet, we can definitely connect offline and share more details.
Okay, thanks a lot.
Thank you. Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1.
In the meantime, there is a question on our webcast, and I'll probably pass this on to Stephen. It's about how well are we working with the government of Zambia, and they see penalties being inflicted on some of the competitors, and what is the situation for Vedanta. Stephen, you'd like to talk about your government relations and how we work with them?
Yes, no, thank you, Aaron. Look, I would say that, over the last few years, we've managed to create a very open dialogue with the government, various ministries in the government of Zambia. But most importantly, I think we're having a very good set of dialogues with the Zambia Revenue Authority. So you are right. Very recently, there was some publicity where one of the other large miners in the country was assessed basically on customs duties, which is now being negotiated. And there have been small assessments on other mining companies as well. But we're in dialogue. We don't believe that we have any large exposures. Our compliance is very good to all of the regulations. And even more so, maybe if I can state that we've had some very positive dialogues with the Zambian Revenue Authority in relation to recouping some of the backlog VAT. So I would say that despite some of the economic difficulties in Zambia at the moment in relation to the budget deficits and the economy, our relationship with the government is good.
Sure. Thank you all then.
Hello.
In the absence of any other questions, thank you, ladies and gentlemen. This concludes the FY18 earnings call of Vedanta Resources. The IR team is available for any queries. The coordinates are on our corporate website. Thank you again.